Rosenberg is one of the best-known economists on Bay Street. He runs Rosenberg Research, and he's here once again with the bond market veteran Ed Devlin of Devlin Capital and formerly of PIMCO. Good to see both of you again. Thanks as always.
You too.
Yep, okay, where do we start? David, where would you like to start things this morning?
Well, that's a pretty broad question. You're going to give me the full half hour?
Well, I think we just heard a whole host of themes there just based on the bank's decision yesterday not to move.
Well, look, we're not going to have a serious recession and no big run-up in unemployment. Well, hallelujah. Look, what he said was that the path towards a soft landing is narrowed, which when you look at it in the mirror image, he's really saying that recession risks have risen. But here's the reality of the situation. I think the recession's already begun. And we had already a fractionally negative print in real GDP in the second quarter. There's no momentum into the third quarter. But there's another part of the national accounts that nobody looks at, except for maybe me and Ed, called gross domestic income. Okay, real GDI, the income side of the economy. And that's been contracting for 4 straight quarters. So beauty is in the eye of the beholder, but you could argue that there are metrics already suggesting the economy is in recession. And here's the bottom line. We have 2.5% to 3% population growth in this country because of the immigration boom. What's the Bank of Canada told us? What did they tell us yesterday? They have real GDP growth of 1% this year, 1% next year, 2.5% in 2025. They're telling you we're going to have 3 years in a row in this country of negative real GDP per capita. And the only time that's happened in history was 1990, 91, 92. And that was the John Crow recession. And who has Tiff Macklem, just as Jay Powell has taken on the label of Paul Volcker, Macklem has taken on the moniker of John Crow. It's 3 years in a row of negative real GDP per capita. So maybe you don't want to call it a recession like Gerald Ford in the mid-70s called it a banana. But it's a recession is staring us in the face if it's not already here.
Devlin, I guess every time we ask our guests about why central bankers are fearful to declare an end to the rate hike cycle if recessionary risks are front and center after all of these aggressive moves we've seen, they say, well, inflation, it gets inside people's heads, it gets inside businesses' heads. That's something they can't quite do. And even the bank yesterday said they expect inflation to be higher next year than they previously thought. So how do you feel about that?
Yeah, so I think that this really is, we're staring in the face kind of one of the worst case scenarios, which is stagflation, right? So you have this situation where we're not really growing, as David was talking about, but you got some sticky inflation kicking around. It's not going to be massive inflation, but if you've got inflation kind of consistently and sticky above target for a bit, this is what keeps rates a little bit higher than they should be, because they should be, I'm with David, should be cutting, and they will be cutting at some point in the not too distant future. But, Tiff and Powell do not want to go down in history as the folks who let the inflation genie out of the bottle. And they're going to be overly restrictive. And I'm with David in that they already are overly restrictive. And, it's coming.
You agree? I keep hearing that narrative. They don't want to be, they want to make sure they, and yet, do they want the economy to collapse?
They obviously don't want the economy to collapse, but it's once burnt, twice shy. Right, I mean, what Ed was saying, the inflation genie had come out of the bottle. That's yesterday's story. They're fighting yesterday's battle, and they've already put the inflation genie back in the bottle. You see, the thing about inflation is not the NASDAQ, it's not Bitcoin, okay? It's not commodity prices. It moves glacially. The fact that these central banks are lamenting that it's taking so long, inflation does not fall off a cliff, okay? So basically, inflation is going in the right direction. The Bank of Canada's own surveys, consumer and business, that they just released last week, showed inflation expectations are moderating. This is a process. So they're fighting inflation. You had in your quip at the beginning, you talked about how mortgage interest is the principal source of inflation. And why did the Bank of Canada raise this inflation? It's because of energy, which they have no control over. So when you actually look at core inflation in Canada, ex-mortgage interest, inflation is running at 2.1%. So what's this fixation over inflation? Core inflation, ex-mortgage interest. Mortgage interest, I don't see anybody going to Canadian Tire and saying, oh, honey, can you get me next to the power saw, that mortgage interest up there? Who buys mortgage interest? It's in the CPI. It's such a flawed statistic. But you strip out all the nonsense, okay? And inflation in Canada is running right at target. They actually should be thinking about cutting rates, but it's hubris. It's hubris that's preventing them from doing that.
Now, the market itself has to make estimations based on what they're hearing from central banks. I was looking, Bloomberg tracks general market views on where rates go. And going into next year, there's sort of a curve that would suggest that we will see some rate cuts by late 2024. But nothing aggressive. The market isn't pricing it doesn't seem to be pricing in anything aggressive. Against what you guys, this economic backdrop that you guys have set the table for here, what do you think happens with interest rates next year?
Yeah, so the good thing about being an active manager is you bet against the market. The market's not always right. So I think the market's wrong. And we are going to see more aggressive. So I think the yield curve, which is inverted, is going to steepen. It's going to be led by the front end, so the short-term policy rates will come down with aggressive central bank rate cuts. But the issue you've also got going on here, which is really interesting and it's really hard to forecast, is you've got to think what they call it quantitative tightening. But basically, the central banks are no longer going to finance all these deficits. The private markets have to do it. And what we've seen is real interest rates are now in the U.S. at 2.5%. For 10-year rates. So you can get inflation plus 2.5%,
right,
by lending money just to the U.S. government, right, kind of thing. So it's come a long way. It's moved about 350 basis points. Could it move another 100 or more higher? Maybe, because the real question is what's the elasticity of demand for bonds?
Yeah.
Right. And when the government steps away, what's the price the private sector will make them pay?
Just wanted to come back to a couple of things when we talked a little bit about the housing market. David, when you hear the comments, though, about a lack of supply from the central bank governor, who takes a lot of the heat, let's face it, for higher interest rates and Canadians feeling a bit stretched right now, how do you explain the dynamic between our central bank and an issue that has become chronic in this country, just not enough housing supply?
Well, look, the supply side is not about monetary policy. Monetary policy can only influence demand. So on the supply side, that comes down to fiscal and regulatory policy. So I would actually say what was very encouraging from what Tiff Macklem did yesterday was he stepped out and gave a message to our fiscal policy makers ahead of the fall statement that fiscal policy has to be joining monetary policy on the same page. So in other words, no fiscal expansion this time around. Those days are over. And it looks like that the finance department is listening because they've already been releasing, some tape bombs ahead of the fact, talking about that it's going to be narrowly confined towards housing, the supply of housing. Well, we'll see what they do. But you see, anything that can bring down home prices, which, by the way, Macklem did address yesterday, anything that can bring down home prices is going to make the Bank of Canada's job much more easy to bring interest rates down to more comfortable levels. Let me just make this point, make it emphatically, okay? Where's the unemployment rate today? It's 5.5%. Where was it in January 2020 before COVID? 5.5%. Where's the overnight rate today? 5. Where was it back then? 1.75. 100% what Ed Devlin said, policy is extremely restrictive. But anything they could do on the fiscal side to alleviate the pressures on prices, which are abnormally high to this day, is going to make the bank's job that much easier. And I think I'm with Ed, that rates are going to be coming down much more quickly and forcefully than the market's got priced in right now.